Welcome. My name is Alidonya Jumbo. Today we are going to be talking about net present value function in Excel. The NPV is one of those calculations that is the must for every financial analyst, an accountant, a project manager, and so on. So every financial analyst should be able to calculate NPV and be aware of its shortcomings in Excel. So the formulas can be very useful for financial analysis in financial modeling in determining the viability of an investment or a project, etc. In most cases, the financial analyst need to calculate the NPV of a series of cash flows, not just individual cash flow. The formula works in the same way either. However, each cash flows has to be discounted individually, and we have to add them all together. So NPV functions assume some things. So these are the functions. There are some assumptions of NPV function in an Excel, which appears to be its flaw. One, initial cash flow is made at the end, and the two, that all cash flow generated from the business occur at the end. And to solve this, we need to quickly introduce this to you. So to the first one, I say the initial cash flow occur at the end. If we want to calculate our NPV, we're going to say equals to NPV rate. That's the discount rate that we're going to use in calculating it. I'm going to select my discount rate here, press comma to move on to my next argument. If my cash flows occurs at the end, all my cash flow, that is my initial cash flow, occurs at the end, then I will have to use this. Then I will apply my cash flow from the beginning up until the end. Then I will say okay. I apply, press enter, then I have my NPV to be 93,000. But we all know that my initial cash flow for an investment will not occur at the end. It's really going to occur at the beginning because I need to invest. I pay my vendors the money, so I will start the project before my money start coming, before we start producing and the money start coming the following period. So the money, the cash flow usually occurs at the beginning. But in order to solve this, I'm going to say equals to NPV, my rate, comma. So by my value, in my value, I'm will start from my year in year one. So my initial cash flow will not be included in A. So I'm not going to discount that like that. So I will add it. Then I will now add I will close this bracket. Now I will now add my initial cash flow to it. A. So in this case, it was actually assumed that my initial cash flows will occur at the beginning. So I need to add my initial cash flow back to my NPV. Okay, so that is one. Also, the second one is that all cash flow generated from the business occurs at the end. So when all cash flow occurs at the end, it assumes that, because we all know that uh, the cash flows, if I'm into the business, I earn cash flow in January, I earn cash flow in February, in June, in August, September, and October. But it's actually assumed that the NPV assumes that all my cash flows occur at the end, and that is at the 31st of December of every year moving forward. But if I have a detailed if I have a detailed analysis of my time, that's my timeline, that's my time period when my cash flow occurs and my cash flows, I can use Xnpv to solve this. But the Xnpv take into consideration the timing of the cash flow. It take into consideration the timing of the cash flow. That is, my cash flow occurs in 1st of January 2019. Another one occurs 1st of October or 1st of March 2019, etc. So, okay, before we actually move into that, I'm quickly going to show you the other one. So, another flaws that we can actually come across in calculating, applying the NPV function in Excel. For example, in a particular period whereby I made I will having a zero cash flow. If I have zero cash flow, if I have zero cash flow like this, and I put in nothing here, you see, when I delete that, my NPV actually reduced. Why? Because it did not consider this year that I have nothing as part of its consideration. So what do I do in a period whereby I have zero cash flow? So I need to put that zero here so that Excel will consider it as part of its calculation. If there is nothing here, there is nothing here. When it got here, it assumed this is the year number 4. When it gets here, it will not assume this is year number 5, even though it will assume this is year number 5, although it is year number 6, but we actually consider it as year number 5. So in a period whereby we have nothing, we should put in 0 here so that Excel will actually consider that time period in its calculation. Also, when we have a series of cash flows that occur at irregular period of time, that is, they all do not occur at the end of the period, like this. I say we are going to use the Xnpv. So we apply the Xnpv by playing equals to Xnpv. What is my rate? My rate is 10%. I move on to my next argument. The next argument is value. What is my value? In this one, I'm going to start from the beginning by applying all my, no, it is this. I'm going to apply all my value from beginning to the end. Only my value. I press comma again. The next argument is the date. So the date at which this cash flow occurs, I'm going to select all of them together, then I will press enter. So the Xnpv is a bit more accurate and more precise when we are calculating net present value in Excel. So it's more accurate because it consider the period, the time when this cash flow actually occur in Excel. Thank you for watching. In our next video, we are going to be showing you on how to calculate our IRR and also the XIR in Excel, and the possible flaws that you can actually come across in Excel. Thank you.